welcome to another video from Creativo Solutions. You're watching the Accounting for Non-Accountants video series. Please post comments and questions below and tell me, how are you finding the current video series? Is there anything else that you need me to answer? Post the question below and I'll review it and post a video to help you better understand the accounting. Last time we looked at the accounting rules. That was the most important video to give you the 6 basic elements that you use throughout accounting. It doesn't matter how basic or advanced the questions are. When we're looking at accounting, there are certain elements that we're going to have to know. Please subscribe to the channel and visit the website for more content and resources to help you. Today, we're going to be looking at the financial position. So I'm going to take this concept and I'm going to build on the basics that we learned from the previous video, which covered all the fundamental rules. It's important to know the rules because we can then identify different elements, because accounts that we get in different transactions can be grouped under specific elements. So there are 3 questions here. What is financial position? How can we measure it? Okay, how can we measure this financial position? And also, when do we measure this? Take a minute and try answer those 3 questions, and then we'll go through the theory together. What is financial position? Well, you should be thinking about if I'm a business and I'm owning assets and liabilities. We spoke about those elements in the previous video. So if you haven't watched that video, go back and watch it to better understand the rules. If I'm thinking about an asset, that's something that the business owns. The more the business owns, the better for the actual entity. So when we look at the financial position, we're actually looking at the net worth. We're looking at how much does that particular company actually hold in terms of net assets and liabilities. Obviously, liabilities aren't good, okay, because the liability is something that we're owing. So we need to then look at the net amount. So assets and liabilities need to be considered together. We'll be either in a good or bad position. How can we measure this? Well, there are different ways of measuring the value of the asset and the liability. We could use costs. So if I buy a particular asset, it'll cost a particular amount. So that would form the actual cost price of that asset. But we know that things that are bought new deteriorate and get old over time. So we could maybe use the market value or the current value. So we need to know how much is that actual asset worth today. And we could maybe use a fair value estimate to identify the actual amount, and that's what we would measure the asset at. A liability is the same. We would measure the liability perhaps at the current value. We hopefully pay off the liability over time, so that liability balance should come down. So we could maybe look at the current value. How much do we currently owe to the various entities that we need to still pay? When do we measure this? Well, if you think about financial position, the value of those assets are going to be changing day to day. So when looking at when, we have to look at a point in time. One point in time, why? Because the financial position will change. Today, I have, let's say, X number of assets. But tomorrow, I decide to purchase another asset, and that increases the total. So now, yesterday I had assets, but today I have more. So has my financial position changed? Definitely. So when looking at financial position, we have to look at one point in time. A single point in time, you'll be able to then determine, well, at that moment, at that point in time, how many assets did we have? How many liabilities did we have? And what was the actual financial position? So we spoke about assets. You can probably recognize some of the pictures on screen. Hopefully you can even identify them as being assets. We've got a laptop, which is a form of equipment. We've got a mobile phone, we've got property, and we've got some vehicles, okay, in terms of a tractor that we could maybe use as part of the machinery perhaps of the business. So it could be machinery, it could be a vehicle, depending on how you classify that particular asset by name. But we know those are all assets. They're assets because we own those assets. They are possessions that we have in that particular business. We also have debt. No one wants debt. Why? Because debt is a liability. It's something that we owe. Do we want to owe lots of external parties? The answer should be no. You don't want to owe everyone. Why? Well, if you owe everyone, you're not going to have net worth or net value in terms of the actual business. So if I'm looking at assets and liabilities, if my assets are greater than the liabilities, do you think that's good or do you think that's bad? Well, you should be thinking about that as being good. Think about it. If your assets exceed your liability, i.e. what you own is more than what you owe, that's really good for the business, because ownership of more of those possessions will give the business more value and wealth compared to owing lots of external parties. Because if we're owing lots of external parties, we're going to have to sell some of our assets in order to meet those liabilities. What happens if our assets are less than our liabilities? Well, then the opposite would occur. That means even if I sold all my assets, I'm not going to have sufficient capital in terms of cash on hand to pay those outstanding liabilities. So if our assets are less than our liabilities, that's a very bad financial position to be in. We looked at the rules last time. This is a note again for two very important elements that we've now looked at in a little bit more detail. When looking at the financial position, the financial position of an entity is calculated by comparing its assets and its liabilities. Remember, the debit side is representing the left and the credit side is representing the right. Assets we know increase on the debit and decrease on the credit. The liabilities increase on the credit and decrease on the debit. So if I'm looking at assets and liabilities, you can see they're opposite. So if I had one asset to one liability, the financial position would actually be 0. If I had two assets to one liability, well, then my assets exceed my liabilities, which is a good place to be. So I'm in a good financial position. Remember, we want more assets than liabilities because that creates a good financial position. We've come to the end of this video. Thank you for watching. Please subscribe to the channel and post your comments and questions below. Tell me if this video helped you. Tell me about all the different assets and liabilities you can think of. Are you guys out there in a good or bad financial position? Let's see if you'd be able to interpret your current situation, be it for your own personal financial position or be it maybe for your company's financial position. Let's see if you'd be able to apply the theory. Let me know where you're implementing the theory and I'll keep posting more videos. Thanks for watching, guys.